Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Interest rates might be tipped to come down later this year, but the era of ultra-low rates is over. And while that might not be welcome news for mortgage holders, global investment giant Vanguard believes the shift to higher interest rates, at least over the longer term, is the single best economic financial development in 20 years, with long-term benefits for markets and investors. Qian Wang is Vanguard's chief economist for the Asia-Pacific region. Also, she heads up their global economics and capital markets model research team. She joins me today from the US. Qian, welcome to Fear and Greed.
Thank you for the invitation. Glad to join you today.
So you recently released the Vanguard Economic and Market Outlook, which is a major piece of work. It looks at the global economy. It kind of talks about a return to sound money. Now, in layman's terms, so I can understand it, so my mum can understand it. What does that mean and why does it matter?
The return of sound money, we meant the interest rate will stay above the rate of inflation in the long term, right? So persistent, positive, real interest rate. Now, in our view, that is actually a very critical difference between investment and speculation, because the former counts on enduring real return over the long term, and then the magic of compounding will help you to achieve your long-term investment goal, while the latter actually seek to profit from the price volatility in the short term. So this kind of cash rate is very important to investor, higher cash rate, because it set the level of risk-free rate. That is a foundation for all asset returns, right? If we use a building block approach, risk-free rate plus term premium give you the long duration bond yield plus credit spread, give us the yield from credit plus equity risk premium, then we get the earnings yield for equity. So leaving any price change aside, a higher risk-free rate should lift up expected return for all asset classes in the long term.
Okay, so I feel like I'm back in a finance lecture here, listening to you here. But it's kind of, I mean, what behind all this is the fact that in recent years, and probably since the GFC, times haven't been normal because we have had, and particularly in recent times, such low interest rates, and you've had inflation above interest rates, and that's not what should happen. Kind of what you're saying, I think, correct me if I'm wrong, is that for the long term, you're supposed to actually have interest rates higher than inflation because that allows you, when you're investing in things like bonds particularly, but along the credit spectrum, equities and that, it kind of sets the ground rules more normally or something like that.
Yeah, I think, over the past, decade, especially after the global financial crisis, we are used to a very low interest rate environment, right? And in many places, you get zero interest rate or even negative interest rate. And at that point, it's like, where is the confidence in those fiat currency? Why we hold cash or why we hold those bond or fixed income investment securities. But now I think there is a critical change. This is what our outlook paper is focusing on, a structural shift to a higher interest rate environment, which will endure beyond the current business cycle, right? Yes, central bank, they will cut this year. But even if they cut, interest rate will settle at a higher level than what we have seen, since the GFC. So basically zero interest rate are yesterday's news.
Yeah, okay. So let's look at some of I want to talk about Australia in a moment, but let's look at some of the global economies. Let's start with the US. What do you think will happen in the US in the next year or two?
Well, I think you look back into 2023, one of the biggest surprise was how resilient the U.S. economy was, right? On one hand, we could say, monetary policy always have a long and variable lag of transmission. So we just got to be a little bit patient. But there's also many other offsetting, forces that actually offset the impact from monetary tightening, right? So if not for those offset, then U.S. economy will be on track for flat, stay flat last year instead of 2.5% in 2023. Now, in 2024, many of those offsets, like excess saving for household, fiscal stimulus will fade, and monetary policy will start to bite. So we actually expect a mild recession in the second half of this year, with unemployment rate going towards, say, around 5% by the end of this year. I think the market is expecting a soft landing. That is possible, but it's not our baseline at this moment. Something has to give. If you want to bring down inflation to 2%, the last mile is always the most difficult. Something has to give, right? So that recession is probably what is needed.
And that means that rates will fall in the US at some point in the next couple of quarters?
Yes, I think slightly different from the market expectation. The market was expecting an early cut, right? Could be starting in March, but in our view, we don't think Fed need to rush into monetary easing at this moment because inflation, especially when you look at the wage growth and core inflation, still very sticky. So inflation is still having the risk that they could reaccelerate if the Fed cut too early, if that is a premature cut. So that's where we think the Fed probably will start to cut in the middle of this year when they see more evidence that labor market is softening and the economy is sliding into a recession. And we expect, about 150 base point to 200 base point cut this year.
Stay with me, Qian. We'll be back in a minute. I'm speaking to Dr. Qian Wang, Vanguard's chief economist for the Asia-Pacific region. Okay, tell me, what about Europe?
Yeah. Now, it's interesting. Europe's story is very similar, right, to the US when you see inflation rising, central bank, hike aggressively. But in Europe, the difference is that the European economy has slowed quite significantly and likely already in a recession. Now, one key difference is that monetary policy tightening is actually much more effective in Europe when the economy actually counts more on the banks for funding rather than capital markets. So higher rates actually kicks in much faster. And also in Euro area, fiscal policy is also more restrictive. So in 2024, we expect, European economy to remain very subdued, 0.5 to 1%, because, monetary policy will continue to bite and fiscal policy continue to be restrictive. And as a result, ECB will also have to cut in the second half of this year by about 75 base points.
Okay, what about closer to home here? Asian economies, and obviously China is and China and Japan are the two big ones for Australia because we export so much stuff to those two economies. What's the outlook for them?
I think one of the biggest disappointment in 2023 was the weak and very bumpy recovery in the Chinese economy, right, following the post-pandemic opening. Now, when you look at China economy, they just announced the GDP growth this week. They actually achieved a 5.2% growth rate, and they achieved their growth target. But that is largely because of very low base in 2022, right? If you look at the economy, the private sector spending and confidence are very weak, and the government is reluctant to stimulate aggressively because of financial stability concern. The good news is that policy support is coming and we expect more. So that could actually help to sustain a continued, but still very weak and slow recovery of the economy. But one thing I do want to highlight about the Chinese economy is that now we come to a better understanding. The downturn in China is not just cyclical, but also structural, right?
Yeah.
You have tons of structural headwinds, demographic, right? A shift in global supply chain. More, property downturn is structural, right? Not just cyclical. And also the strengthened control of the state sector in the economy that is actually hurting private sector animal spirit. So, putting that together, I would say when you think about the trend growth of China before the global financial crisis, it was over 10%.
Yeah.
Now we say it's probably in the low 4% range. And we expect it to decline further to say around 3 or even below by the end of this decade.
Okay, very quickly, Japan.
Yeah, I think Japan is actually coming to a better situation at this moment. Japan actually has gone through 30 years of deleverage, especially in the private sector, right? Both corporate and household. So to that extent, at this moment, when you look at the Japan private sector, their balance sheet is very strong. And then from an income perspective, corporate profit and also the labor market and wage growth is actually picking up. So I think that they are in a better situation, and the economy is also getting out of this deflation or low inflation mindset because of a structural shortage in labor supply, as well as a structural shift in terms of price setting and wage setting, behavior. So, down the road, I would say in the very near term, I think Japan is still facing a lot of significant external headwinds, right? Given they are so reliant on global, manufacturing demand. So I think in the near term, there could be more cyclical headwinds, but I would say if you look beyond 2024, I think there's actually more upside from the Japan side, and as a result, BOJ will have to continue with normalization, hence lifting the interest rate out of the negative territory.
Okay, so putting all this together, the return to sound money and what you've just talked about in terms of the sort of macroeconomic outlooks for those economies, what's it mean for investors? So if I'm an Australian investor looking to invest overseas in one of those big economies, we know interest rates are going to be higher. We know that kind of things are going to be back to normal, whatever normal is. And you've just given us a rundown on the economies. Where should they be looking? Is it kind of back to more traditional 60-40 portfolios?
So you see, I think the transition towards a higher interest rate could actually lead to a lot of volatility in the near term, right? As you actually opened, for household, they have to, saving will be more attractive, borrowing will be more costly, right? For business, that's the same as well. And for government, higher rates will raise concern about fiscal sustainability and force a reassessment of fiscal policy. That's the same for investor. Right? When we are in this kind of a shift towards the higher interest rate environment, a lot of adjustment will need to be made. One example we can use is bond, right? For the past 2 years, it has been quite painful for our bond investor, right? However, the good news is that when the transition is done, higher interest rate will provide a good foundation for higher risk-adjusted return, right, in the long run, right? So now we are heading towards the end of the structural shift, and then central bank across the world is already at the peak of the hiking cycle, right? So then for bond investor in particular, the worst is behind us, right? The price, suffer. On the other hand, the higher interest rate means you got higher coupon income, right, in the long term. So from a long-term perspective, our bond market return improved from 1.3 to 2.3% 2 years ago, right? When interest rate was literally zero, to now 4.3 to 5.3% from the bond market, right? And also with higher bond yield, we also say the diversification benefit of a bond in a balanced portfolio is also back. Right. So this is where we say bond is back. And because of better return outlook of a bond, even for, balanced, say, 60-40 portfolio, their outlook also improved quite significantly. Right. Now, of course, you could say, shall I stick to 60-40? I would say because of the significant improvement in bond return, equity return is still decent, but relative speaking, we would prefer bond at this moment. So this is where we would advise a more conservative portfolio for investors at this moment.
Qian, thank you very much for talking to Fear and Greed.
Thank you.
That was Dr. Qian Wang, Vanguard's chief economist for the Asia-Pacific region. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.